Hello and welcome. Today, I want to discuss a controversial yet crucial topic: why algorithmic trading and technical analysis often fail when applied to trading. Many traders dream of developing an automated system that generates consistent profits, allowing them to relax on the beach or hit the slopes while their trading bot works for them. Unfortunately, this dream is far from reality. In fact, the very nature of the financial markets makes it nearly impossible for retail traders to compete using algorithmic strategies and technical analysis. Let me explain why. The dominance of high frequency trading. One of the biggest reasons algorithmic trading fails for retail traders is the overwhelming presence of high frequency trading firms. These firms have access to ultra low latency infrastructure, co-located servers at exchange data centers, and sophisticated algorithms designed by teams of PhDs and quantitative analysts. Their trading models operate in microseconds, far beyond the capability of any retail trader's setup. Think about it. These firms spend millions to gain an edge that lasts mere fractions of a second. If they're investing this much into infrastructure just to capture small pricing inefficiencies, how realistic is it for a retail trader to expect long-term profitability from an off-the-shelf algorithm? The reality is that HFT firms dominate the short-term trading space, leaving little room for retail traders to compete. Even if you develop a seemingly profitable strategy, the HFT firms can quickly detect and adapt to it, eliminating any potential edge you might have had. The illusion of technical analysis. Next, let's address technical analysis. Many traders rely on chart patterns, indicators, and historical price movements to make trading decisions. But when these strategies are tested under rigorous conditions, they often fail. Consider this. If technical indicators like moving averages, RSI, and Fibonacci retracements actually worked, wouldn't hedge funds and institutional traders be using them to generate billions in profits? The truth is, most professional traders dismiss technical analysis as unreliable. Markets do not move in predictable patterns that can be exploited with simple trend lines or oscillators. If you run a proper backtest, most technical indicators show little to no statistical edge over random chance. They might appear to work in hindsight, but when applied in a live trading environment, the results often disappoint. This is because market conditions constantly change, and any historical pattern that did work is quickly arbitraged away by institutional traders with better data and execution capabilities. The death of retail algorithmic trading. With Python, AI, and countless trading libraries available for free, more and more traders are attempting to automate their strategies. However, this increased accessibility means that any potential inefficiencies in the market are exploited faster than ever. Back in the early days of algorithmic trading, there were genuine opportunities for retail traders to find profitable strategies. But today, every possible edge has been tested and utilized. The moment a profitable strategy is discovered, firms with more capital and faster execution absorb that edge and make it disappear. Even if you do manage to find a profitable algorithm, you'll face additional challenges such as slippage, execution delays, and brokerage fees. These factors further reduce your expected profits, making it nearly impossible to sustain an edge over the long run. Real-world example, SPX options trading. Let's apply this to SPX options. Many traders attempt to use algo trading to capture small pricing inefficiencies, but the bid-ask spreads, market maker interventions, and rapid order book changes make this incredibly difficult. Imagine you develop an algorithm that exploits a small mispricing in the SPX options chain. At first, you might see some success, but as soon as your strategy is detected, the market adits. Market makers adjust their spreads, liquidity dries up, and you're left with unfilled orders or poor execution. Furthermore, let's talk about commissions. Even if your strategy has a small theoretical edge, once you factor in commissions, data costs, and slippage, that edge often turns negative. The only people consistently profiting are the brokers and exchanges facilitating your trades, the false promise of automation. Everyone wants to believe they can automate their trading and make money effortlessly. It's a compelling fantasy. Build a trading bot, turn it on, and watch the profits roll in while you enjoy life. But this is an illusion. If automation truly worked for retail traders, wouldn't everyone be doing it successfully by now? The reality is that automated trading is not a magic bullet. Even institutional traders, with all their resources, constantly adjust and refine their models. No single algorithm can indefinitely generate profits without being adjusted for changing market conditions. Additionally, automation doesn't eliminate risk, it amplifies it. A poorly designed algorithm can blow up an account in minutes. If you don't have a deep understanding of market microstructure, risk management, and algorithmic execution, you're setting yourself up for failure. Conclusion: a different approach is needed. So, where does this leave retail traders? If algo trading and technical analysis don't work, what's the alternative? The key is to understand the limitations of these approaches and focus on strategies that do not rely on speed, predictive indicators, or automation. Instead of trying to outcompete institutions on their terms, retail traders should explore alternative methods such as statistical-based strategies, options fundamentals analysis, or structured trade setups that institutions cannot easily exploit. Trading is not about finding a magic formula. It's about adapting to market conditions, managing risk effectively, and developing an approach that aligns with how the market truly operates. The bottom line is this: if you're relying on algorithmic trading or technical analysis as your primary edge, you're likely fighting a losing battle. The market is already dominated by players with better tools, faster execution, and deeper resources. Instead of chasing automated solutions, it's time to rethink your approach and focus on strategies that actually have a sustainable edge. Final thought: finding a true edge. If you are serious about learning and becoming profitable trading options, possibly making it your main job, you need to find areas of the market where you do not have a disadvantage, or better yet, where you have an edge over the big financial players like hedge funds, pension funds, and large investment firms. With options trading in particular, controlling risk is absolutely crucial. Unlike stocks, options have multiple moving parts: volatility, time decay, market makers, and liquidity. If you don't manage these risks effectively, they will quickly work against you. Dedicate time to learning, refining your strategy, and testing different approaches before increasing your risk. As you become more proficient, you can scale up, but never rush into heavy risk exposure without experience. The market is unforgiving, but with the right mindset and a realistic approach, profitability is possible. Thank you for listening.